if you think about 2023, or if you want to consider recession risk, we have to start with the mismatch in the labor market, because right now it is a quote unquote tight labor market. And labor economists use that term, meaning labor demand exceeds labor supply, where here in the orange line, the total number of unfilled job openings or vacancies is nearly 11 million. That's the orange line here. And it's up 50% from pre-pandemic times. So we've had a huge surge of labor demand. And if you're a recruiter, if you're a TA leader, you probably are maybe nodding your head. Yeah, I'm trying to fill these positions. I can't get enough bodies. Well, part of the reason is the supply is so much far below we would typically see. The imbalance here in the blue line, this is the number of unemployed people in the U.S., and it's below 6 million. So if you think about this ratio, it's almost 2 to 1, almost 2 open jobs for every unemployed person in the U.S. When over the last 12 years, as you look at this chart, you see that the blue line historically was typically above the orange, meaning there were many unemployed people, 3 or 4 unemployed people for every 1 unfilled position. So this imbalance is driving a lot of recruiting challenges, and here's where I'm bringing it back to pay transparency. It's no coincidence that these pay transparency laws are being enacted, they're being drafted, they're being passed in the middle of a tight labor market. There's no coincidence, right? Because it's already a position of strength for workers. They have more bargaining power in this labor market. And one way they're manifesting this bargaining power is by public support to have transparency in job postings and know what pay they're maybe going to sign up for. But another way is just to ask for pay increases outright. And so here we're tracking wage growth. And so it's still very strong. We look at average hourly earnings, and through last month in October, average hourly earnings were up 4.3% for private sector workers who were non-managers. This is 80+% of the entire U.S. workforce. These are people who are in the private sector, not government employees, and they're not supervisors. So these are production frontline employees. Their wage growth is quite strong, 4.3% over the last 3 months at an annual rate. That annual rate of wage growth is well above the 2 or 3% range you would typically see like pre-pandemic. But it's coming down. It was at 6, 7, 8% earlier this year or late last year. We've had very strong earnings growth for workers in this economy, right? Why? Because of that chart I just showed you, because of the imbalance. The story here is that this wage growth, while it's strong, it's moderating. It's trending downward. And you see the blue line is the 1 month change, which can be noisier because it's just 1 month of data. But that 1 month of annualized earnings growth is below 4%. So this is trending down in the right direction from the Fed's perspective. The Federal Reserve, our nation's central bank, has been concerned about really high wage growth as fueling inflation. So that's part of the reason we have this talk of a recession coming, is that the Fed has hiked up interest rates to cool inflation and to also cool wage growth. Well, actually, so far we're trending in the right direction. One last caveat. This is nominal wage growth. This is not adjusted for inflation. In other words, if you think of inflation, like we just learned this morning, that the year-over-year growth in the consumer price index was around 7, 8%. That's going to, for most workers, it's going to erode the buying power of these wage increases. So that's an important caveat, is that inflation-adjusted wage growth is actually negative for most workers. That's another concern for this economy. But the point here is that wage growth right now is strong. Even if it's moderating, it's strong because the labor market favors workers. Now, another way that workers can exercise their bargaining power is by quitting. And this is quits rates. So these are also elevated. This is what you hear when you hear about the Great Resignation, right? This is quits rates, the share of workers who quit in a given month. And they've started to come down a little, but they're still elevated compared to the pre-pandemic level. You look at leisure and hospitality workers, this dark blue line at the top, they have really high quits rates. So people who work in restaurants and hotels, they're quitting a little less than they were earlier this year when quits rates were like at 6%. Now they're at 5.3%. Same for retail workers, the light blue line, where they were quitting at nearly 5% earlier this year. Now they're at 3.7%. You can go on down the line and look at it by industry, but the story here is that quits rates, the overall quits rates in the black line here, yeah, it's still elevated, but it's coming down. And so just like nominal wage growth is coming down, this is further sign that the labor market is cooling from being like white hot from being very tight to being a little less tight. And as this is happening, and as recession fears grow, there is concerns about layoffs. Now, so far, a lot of the layoffs you hear about are concentrated in the tech sector. The overall labor market hasn't really seen a big uptick in layoffs. And I think this is important context because people get kind of hyperventilated about, hey, you know, everyone is going to crash next year and we're going to have soaring unemployment. I don't think that's the case because look at this dashed line here. What I'm showing you is weekly unemployment insurance claims, which is like a good measure of layoffs. When people get laid off, they go and they file for UI claims, typically. Now, the pre-pandemic trend, this dashed line here, is quite low because we had a strong labor market pre-pandemic. And even just compared to last year in 2021, where we had pretty elevated UI claims, we're really low. We're really still seeing pretty low layoffs. Now, this may change over the next few weeks. You'll see that, you know, Meta has laid off some workers, and that may affect, you know, it's 13,000 workers, but the average weekly claims here is around 250,000. So the story here is of a still tight, quite tight labor market. But as this labor market is tight, it's colliding with forecast of a recession, right? People say we're headed for a recession. You hear this a lot. There's actually a poll from the Wall Street Journal of business economists. And for the first time ever, the probability, according to all those panelists who were surveyed of business economists, for the first time since the pandemic, the probability of recession went above 50%. It's around 60%, according to that poll. 60% is not a sure thing. It's not a guaranteed recession, but it is notable that sentiment is souring. The mood in terms of consumer confidence is souring. And why is it souring? Well, the big reason is inflation, right? Is 40-year high in the prices over the last few months. That kind of led to the interest rate increases that's concerned people about slowing growth. And sure enough, earlier this year, we did have real GDP growth go negative. That's the blue bars here. They went negative for Q1 and Q2 of this year. Now, there was a recovery in Q3 of this year. GDP was at a pretty solid growth. So that's where we've had growth rebound a bit this year. But where is it going next year? I'm showing you projections for real GDP growth in 2023, next year, in 2024, in 2025, and so forth. And these projections come from the Federal Reserve in their most recent outlook. Now, the growth that they're projecting, maybe it looks like a strong rebound to you because the columns are so much bigger, but it's actually pretty modest growth. The y-axis here only goes up to 2%. So the Fed is projecting growth in 2023 just above 1%, okay? So modest growth is projected, a still tight labor market is projected, inflation has been high and interest rates have been ratcheted up. So what are the odds of a recession?